This episode of the podcast is brought to you by First United Land Transfer. Enjoy the conversation. In this episode of Beyond the Closing, I'm meeting with Ralph Trinidad, a local lender, and we're going to talk about a couple of things that we've actually seen on social media, and we're going to answer some of the questions about interest rates. And it just seems like it's a big concern out there. So Ralph, thanks so much for being here. I'm not going to shake your hand, but namaste.
Yeah, thank you very much for having me, George. I really appreciate your time as always. First United does a great job of putting out solid information that helps our local real estate market. And I think that in times like this, adding value out there to our clients and for consumers who are looking for information is really, really important. So thank you.
That's our goal. And thank you, Ralph, for being here today. So Ralph, you know what? One of the things that I've noticed as I'm scrolling through social media is, people are actually sending apples to oranges, and they're comparing interest rates. And, just recently, not too long ago, the Fed had actually cut interest rates down to zero. And I was wondering, how does that affect mortgages?
Yeah, so George, that's actually a really great question because a lot of people see the same, right? So they saw that last Sunday, the Federal Reserve made a decision to cut interest rates down to 0 to 0.25%. So that represented a full 1% cut on their end. However, most consumers want to know how that applies to them, and specifically with regards to buying a home or refinancing their current mortgage. So the Federal Reserve cut doesn't necessarily cut mortgage interest rates. They're two different things. The Federal Reserve cut will actually have a greater impact on short-term securities such as consumer debt. So car loans, credit cards, boat loans, sort of things like that will be more directly impacted by the Federal Reserve cut. So it is an apples to orange comparison. However, Sunday during the same press conference, they made a decision and announced a decision that has a greater impact on mortgage interest rates, which was that the Federal Reserve will actually be buying $200 billion of mortgage-backed securities. Wow. Now, this decision will have a greater impact on mortgage rates and what happens in the near future. So,
tell us a little bit more about what that means.
So,
to the consumer, at least.
To the consumer, so what's happened over the past few weeks is rates were in a really great environment. I'm certainly not an economist by any stretch of the imagination, and I don't want to present myself as being one. But if things out there with regards to interest rates that are going to directly affect my consumers, I think it's in my best interest to do research on. So I follow these things closely, right? And I've tried to do my best to educate myself so I can in turn educate my consumers and my clients, right? Of course. So for weeks, interest rates were heading in the right direction. And about 2 weeks ago, we saw a major dip in the 10-year Treasury, and the 10-year Treasury went below 0.5%. Okay. If you wanted to know what was going to happen with regards to mortgage interest rates, for quite some time, it was really in your best interest to follow what happened with the 10-year Treasury because they would generally follow each other pretty closely. However, 2 weeks ago when that major dip came, it had a negative impact on the mortgage bond market because of that dip happened so drastically. Whenever there's that sort of uncertainty in the market, markets can react unfavorably. If you see it in the stock market and you saw it in the mortgage bond market 2 weeks ago.
So what did that do for the interest rates at
the
time?
Last Monday, interest rates started to creep up. And it crept up substantially all throughout the week. So the people who were seeing, all right, this is a perfect time to refinance, finally got enough nerve out there to contact lenders, and what they were met with were higher quotes than they were expecting because of what's happened in the bond market that Sunday into that Monday 2 weeks ago.
Right.
Yeah.
And it was night and day. It was almost twice the amount, was it not?
So not necessarily twice the amount, but I think that interest rates probably crept up almost a full percent during the course of the week, and there were a couple major factors that led to the increase in interest rates. Right, so most mortgage lenders out there who have servicing rights were actually losing margin with regards to servicing because when your lenders out there who are servicing mortgages, they're not the owners of those mortgages. Okay. They actually buy those servicing rights with the agreement that they'll take a servicing fee each month in order for them to service that loan, right? Normally, consumers will keep their mortgage for at least a 3-year term. The mortgage lender itself is putting themselves out there with an investment of buying that servicing right. They'll recoup that the fee that they made up through what they're being paid for servicing rights over the course of the next 2 or 3 years. Right. Well, now you have more and more consumers refinancing who maybe just even bought their house 6 months ago. This is having a direct impact on profitability by the servicer. So they were losing a lot of money on the servicing rights. They were also losing a lot of money based on what they already had in their pipeline for the 30 and 45 days previous to what's been going on in the market, right? So if you think about this, George, if you are buying a home, right, and you are under contract and your mortgage professional got you locked in at 4%.
Correct.
And now you're seeing everyone out there in the market is being able to get 3.25%. You're probably going to pick up the phone and call your mortgage broker or bank and say, hey, we locked in at 4%. Can I do any better, right?
Right.
All right, well, that's what majority of people who were doing. So what it was causing on the lender side is to have to renegotiate their rate locks. So in essence, losing more margin. Or if you were locked in with a lender who wasn't able to renegotiate your rate lock, most or a lot of people were going to different banks. So you pull your loan out of a pipeline with one bank, go to another. So again, there's more sunken cost for that bank. And then the last thing that was a really big impact on the mortgage rates going up is the uptick in refinance applications was tremendous, and all lenders out there were at or near capacity. So it caused this influx of business caused pipeline management, and it really stressed the infrastructure for all mortgage lenders out there. So some of the mortgage bond activity increased the interest rates, but some lenders out there actually artificially increased rates to try to prevent the influx of mortgage applications coming in.
Interesting. So let me ask you, how does that affect the consumer today? Somebody who's actually looking to perhaps buy a house. I'm assuming rates are actually still fairly low.
Yeah, so rates are still fairly low, and if you look at 30-year averages, they are still historically low, right? We're not at the very bottom, but doesn't mean it's not a great time for us to look at buying a home, right? So if you're still looking to buy a home, I still think that timing can still be right. Rates are still great. Just because you're not bottoming out doesn't mean they're not fantastic, right? So I would just say, talk to a mortgage professional. Keep your eyes on interest rates. For a lot of our consumers, what we're doing is we're still keeping our applications moving forward. We're putting rate lock trackers on each individual file, so we know what the goals are of our consumers. What they're trying to achieve, and if we can get to that rate that they're looking for, we'll call them up and we'll lock them in, right?
So when you pull somebody's credit and you started an application, how long is that good for?
So when we pull a credit report for our clients, most, if not all, of mortgage lenders out there will require that your credit report be within 90 days of our funding date. So that's a good rule of thumb for us to look at. Our credit report's good for 90 days. If we get anywhere past that point,
so you have 3 months.
We'd have to look at a new credit report at that point.
Very good. So, in the next 3 months, anything could happen, which means that if you do start your credit application now, it's probably a good idea to, B, it gives you the opportunity to, if rates do go down, to lock.
Absolutely.
Where if you have the fear of perhaps not starting your application, you might not actually be able to take advantage of those great rate prices.
Yeah. So there's so much volatility in the market right now. Things have been up and down, where the volatility shouldn't necessarily scare you away from seeing if you can save money, seeing if you can accomplish your goals. but you can always start that mortgage application, have your rate lock be what's called a floating rate lock, where you can take advantage of any volatility that brings rates down. And again, as long as you're dealing with a solid mortgage professional who helps you keep an eye on the market, we certainly wouldn't expect that everyone out there looking for a mortgage loan today be an economist and wake up every morning and look at Yahoo Finance and those sort of things. But align yourself with a mortgage professional who can do those things, sort of things for you, and work as an advisor on your behalf.
Perfect. Well, I want to thank you so much for being here today. I know a lot of people are actually spending time with their loved ones, and as of today, well, that's really the thing to do, spending that time with those you love and making sure that you and your clients are protected. So thank you so much. Thanks for being here.
Very welcome, George. I really appreciate your time. Thank you for having me.
Likewise. Take care. I hope to see you soon.
Absolutely.
All right.
Me too.
Thanks, everyone. I hope you've enjoyed, and I hope this is able to answer some of the questions that you have out there. Any questions, please feel free to let us know.